Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, very excited to be welcoming another international man of mystery. He is the travel lifestyle, real estate, playboy, junior resource maverick. That is James Mackay. Follow him on Twitter, guys. Very, very entertaining profile and has a fascinating story into which we're going to dig today. Before we do, a little bit of housekeeping. Nothing that's said here today is advice. It's just two guys talking about investments, lifestyle, and whatever else we happen to cover. You're responsible for your own due diligence. So without out of the way, I would love to introduce you, James. How are you, my friend? And where are you in the world today?
I'm great. That was that introduction made me blush there a little bit. I'm in my apartment here in Mexico. One of my Airbnbs here. Somebody's checking in about an hour and a half, so we got about an hour and a half to do this. And I'll be here for the next 4 months, and then after that, I intend to go by some places in Colombia.
Very interesting. And Airbnb has been quite topical recently with some of their changes in price. Can I get you to start off with just a 2-minute background into yourself, where you grew up, how you ended up in investing, and how you ended up living this lifestyle that we're all following on Twitter, where you're in a different Airbnb every week, it seems?
Yeah, okay. So growing up, I was an athlete until about the age of 22, and I realized like I'm probably not going to become a millionaire playing beach volleyball for Canada. And in Canada, I was always winning. When I went to the world stage and world championships a couple times, I wasn't. And I realized that if you're not top 10 in the world, you're really not going to make it financially that way. So I was going to U of T for Bachelor of Commerce and Finance, and I was taking a lot of advanced macroeconomics and macroeconomic modeling courses. And I became kind of serious with that my last 2 years. I wasn't the best student before that, I was good, but final couple years, I spent a lot of time on that. And then I graduated during the financial crisis when there were no jobs available to anybody in 2008. And in retrospect, it was a blessing in disguise. I was very lucky to graduate without crippling debt. My grandfather was one of the top stockbrokers in Canada, and he paid for most of my university. So I finished, and I knew of, I bought my first stock with the money that I had, and it was called Graystar, which became Eco Oro in Colombia. They had 15 million ounces of gold, most of it open pitable. They had $110 million in the bank, and they were trading for $50 million. Is like by any metric, it was 4 times your money just by buying the stock. Everybody else had panicked, and I had just be like, oh, this stock market, let's take a look at this. And I had just learned about valuation, and I bought that one, and I kind of got hooked from there. I got my first, within a couple months, it was 3x my purchase price, and I started traveling the world. I went to Australia. I visited your country. And from there, I haven't really had a job. I've just had a bunch of winners in the stock market, and now it's like 14 years later, I'm here in Mexico. So that's, I guess, my background and how I got into it.
Well, that's a great start. And so with your university education, how much of that did you find helped you? Some people find that they don't really use what they learn at university. They kind of learn from the school of hard knocks. I imagine you learned some valuation metrics, and that enabled you to identify the opportunity with that first investment. How much would you say you use today that you learned from university?
Oh, not nearly as much as I should. Tell you the truth. I mean, I think in the stock market, at least half of it is psychological. I mean, you might be better off studying psychology, human psychology, and human groupthink than you are studying business. Like, yeah, of course, you need to understand numbers. You need to understand financial math. But in terms of actually like making money, if you want to be a trader, the human psychology probably plays a bigger part of it, in my personal opinion. In grand investing, specifically in the resource space, which I think you and I both focus on, at least currently, they're very, very cyclical. So you want to be in it sometimes, and you don't want to be in it other times. Like if you were in it from 2012 until 2020, you had a bad time.
Life was rough.
You had a really bad time, So the advanced macroeconomic modeling courses were basically all the rules changed with Ben Bernanke. Well, they kind of changed with Greenspan beforehand, but Bernanke changed them all.
Took it to another level.
Right as I graduated. Yeah. So, I didn't really apply those. The trading course that I took was great, but it was quite basic at U of T. I would say that the corporate finance courses were probably the most valuable in terms of valuing future cash flows, discount rates, and yeah. And I remember I started studying for my CFA. I actually took the first test, and I killed like a couple different sections, and I failed a couple different sections. And for the rest of my kind of like investing career, I just focused on what I did good at, what I did well at. Yeah, so most of it was the corporate finance side, and just like reading income statement and balance sheet, and doing very, very basic stuff that most people just don't want to do. Yeah. Right.
And so how do you
don't even really need to build models if you're able to look at the financials quite well, and realize what the company is doing and speak to management. So it's just like the small legwork that most investors don't want to do. If you do that, you can have an edge.
Okay. And what would you say your investment process is? Are you like a top-down macro kind of guy, and you're looking at certain sectors that you think have got tailwinds, and then you dive into those sectors to find the best individual opportunities? Or do you not care about any of that? If you see something that you think is cheap and that you like, and that maybe has a catalyst to the upside, you're going to delve in and do your due diligence. Talk to me about how you start to view an investment from the start of an idea through to actually pulling the trigger and taking a position.
Okay. Well, there's many strategies, but in general, let's just talk generally. I like really big themes, because if you get the big theme macro right, even if you pick the wrong horse in the race, you're still going to make money, right? And I like buying things that are unloved and cheap in general, probably be like on a discovery scale, when people aren't really thinking about it, or companies that are already in production that are about to make a lot of money and the market isn't pricing that in. So I guess those would be the big ones. Like the biggest winners I've had have been discoveries, mostly in gold, in the past, but more recently, the last 2 years have been basically all in energy. Haven't really been focused on gold. So I would say in my first few years, when I caught that big wave from 2008 to 2011, it was all discoveries and future potential of these resources. And some of these companies went from pennies to multiple dollars. So that was then. Now I'm a lot more focused on, okay, who's going to make stupid amounts of cash flow and who can buy back their shares in a down market, and defend their own stock or pay giant dividends. Yeah, that's good too. I prefer the former to the latter, but it's a matter of valuation, really. So that would be my general style. I guess it would be top down. And then what I really like to do is get a basket of companies that I like within the sector that has the macro moving ahead for it, and then rotate in amongst the companies that I like. When one shoots up, I might sell a bit more of it, and one shoots down, I'll buy more. It's basically try to buy panic days when I feel like puking, and when I feel like celebrating and partying, I try to take a little bit off. And that's generally what I've done the last 2 years, and it's been quite successful.
Okay, very interesting. A little bit more active approach into rebalancing. Given those positions, how many positions would you normally be running in a typical year in your portfolio?
I run too many. I wish I didn't. I was just talking to a friend about this. I wish I had more like 15. Right now I have something like 25, because I just keep finding things that I like and then just buying small portions of it. And you and I, before this call, we're talking earlier, I was saying like anything less than a 2% position, you kind of sometimes forget about and you don't pay too much attention to. So I tend to have maybe between 5 and 10 stocks that I watch really, really closely. And then I have a couple potential home run plays. And then I have a couple diversifiers, I guess. Just like, I can't be all in oil. I want to be all in oil. It's just, I can't bring myself to do it, So I have some diversification, even though I'm very, very much concentrated in energy. And we'll go into that, I guess, in this chat.
Okay. So you've got, I would say a fairly decent amount of positions, but you're more heavily weighted and concentrated, obviously, to the ones you like most. And then you're kind of running a longer tail where you're keeping an eye on some of those smaller positions. And if something happens, you're ready to allocate capital into some of those you think are ready to outperform. Leading into,
I usually don't have more than 15 or 20% in one name. Like that's kind of like the max, right? Like,
well, most people would consider 15% in one name quite concentrated anyway. So I think that's why you're watching it closely. And if you do have that conviction, that allows you to really make some big home runs should your investment thesis play out, right? So moving into macro, like what do you see is happening in macro trends at the moment? We can talk about public stocks. We can talk about real estate, which I know you've always got your finger on the pulse. Maybe starting with the global economy and stocks. Which sectors are you most bullish on at the moment, and which sectors are you the most bearish? What would be your thesis?
I'm more or less all in energy still. I think we're still in early innings of that. If you look at previous cycles and how long they played out over large scales. The capex cycle of these are quite long, and the last 6 years, 7 years. I mean, I do have a chart on this somewhere. We can share screens in a bit, but the general theme is underinvestment in commodities for the last 7 years, and where you're going to make the most money in that. The second general theme that I've been looking a lot at, I forget who first said it, but I don't want to say that I'm anti-ESG, but betting against ESG seems like the most profitable trade possibly in our lifetime that we're going to see.
And talk to us about that. Is that because it just, the narrative just does not match up with reality and arithmetic? And so you see this big bubble that you know is going to fail. How are you doing it? Are you going to short tech stocks? How are you seeing it, and how are you playing?
I wish I shorted tech stocks. I bet you wish you shorted tech stocks too, but no, I don't really have the balls to short, mostly because through most of our investing lifetimes, we haven't really seen real QT, quantitative tightening, or a real interest rate hike cycle. Like we've seen it over the last 6 months in rapid succession. How long is it going to last, given the US is 130% debt to GDP, and Congress and Senate plus Janet Yellen are kind of like, okay, Jerome, it's time to hit the brakes here. Every economist in every newspaper is writing like, okay, Jerome, you did a good job, it's enough. It's like Jerome against the world right now, right? So that's a big theme for me, is how this 50-year debt cycle is going to play out, and what's going to come afterwards. But the biggest thing is just like, okay, everybody's fear mongering this climate change. And I guess one way to do it would be if you had a private company that installs solar panels, and you have government contracts, you just mark them up, or wind turbines or whatever. That's one way to play it. But I think the better way to play it is just realizing that the inputs of energy for solar and wind versus the output of energy that they give you is such that you're going to need continuous investment, reinvestment, to the point where you're going to end up using more coal and diesel than you probably expected in your models. And if you're not allowed to build a coal plant, and if you're not allowed to drill on federal lands for oil, I feel like those are the two big winners over the general overall macro theme right now. But like, you've seen that chart from Our World in Data, right? Which kind of shows you, okay, we started at coal, then we went to oil, then we had natural gas, then we had nuclear, and now we have some renewables.
You can share your screen. I've given you permission, and we're talking about energy return on energy investment for different type of molecules. So what allowed us as humans to progress and to have a larger population literally on the planet was around this ability to have a source of energy that provided more units of return on energy invested. So when we started off burning wood and lignite, or later on into lignite, we could only sustain a certain amount of people. But then we had the Industrial Revolution burning coal. And then we started to move to hydrocarbons like natural gas and oil. Then we hit the nuclear energy side of things. And this is the key point today, where we are at the first time in history where policymakers are actively trying to push us backwards in terms of that rate of progression from sources of a higher energy return on energy invested to a lower energy return on energy invested, which would be the ESG solar wind type argument.
Yeah, you said it very clearly, concisely. I have a feeling you've said that before. Let me see.
Well,
I
do a podcast in my spare time.
Let me see. Share screen. Okay, actually, the first thing, I just have a Google Doc that I pulled up some of the things that I've shared on Twitter.
Let's take a look.
How do I do this? Share. Just, can you see it?
Yes, sir.
Okay, before I show the Our World in Data thing, I'll just, because this is going to wrap it up kind of later when we start talking about diamonds. The last 15,000 years, right, in terms of temperature on Earth, this is coming from ice drill cores in Greenland. There's this study that was done as to what the temperatures were, expected temperatures were going back. The only reason I'm showing this is just because in order to properly assess climate change, we need a much bigger data sample than the last 30 years or 100 years, even more, and we just don't really have it based on, okay, what's going to happen with the methane and carbon dioxide and other rest of the greenhouse gases going into the atmosphere. We can model it out, but there's so many variables that we don't know exactly how far we are affecting climate change versus natural climate change. And this is just like one graph. It shows this particular period. I don't know if you can you see my cursor?
Yes, yep.
Okay, so the Younger Dryas is when the glaciers in North America rapidly melted, right? And went into the ocean sea levels rose. It happened incredibly rapidly. We're going to wrap this back up in the diamond. This is an interesting part of what we're looking for in diamonds. But how do I got to go down screen here. Here we go. Yep. So this is the chart that I was talking about. So the general macro landscape right now is such that, okay, we have inflation. In about May of last year, it really started, the first signs of inflation in the US started showing up, and Jerome Powell just said basically like, it's transitory, don't worry, right? And I just thought to myself, no, it's not. Buy oil, buy oil, buy oil. I was already in oil. I thought the inflation was coming, but that day and around the FOMC, it sold off pretty hard. And then the next FOMC meeting, it sold off pretty hard as well. But in between, there were all these giant gains. So the question is, if you look back in history during inflationary times, what were the best performing assets? Number one was energy. Number two was gold. Number three was real estate. Basically, those are the performers. Healthcare was basically flat. And then the rest of the sectors were more or less negative. And tech was very negative, right? So the question is, okay, it's 2022 right now, but in 2020, 2021, which of these particular sectors are going to do the best and why? And you're comparing one versus the next, and you're also comparing in your mind, is the world going to grow? Are we going to continue on this trajectory, or is this COVID nightmare that we went through going to continue such that the energy consumption is going to be less and less every year? Well, I think Jeff Curry, yeah, it was Jeff Curry. He made the comment that in the last decade, the world invested over $3 trillion in green energy, and only really decreased the amount of hydrocarbon usage from 82% down to 80. Well, it's actually 1.5%, right? And this year it's arguably up because coal usage is up. So, and about...
Which is used to manufacture solar and wind equipment in China, by the way, guys.
Yeah, I have that on one of these slides as well. So I forget who said it first, but somebody said a thesis that more green energy leads to more coal usage. And this was before coal took off. And I started taking a little bit of a look at that. And the more you rely on intermittent energy, the more you need on-demand energy. And what's the best form of on-demand energy? It's basically coal, unfortunately. So the thesis made a lot of sense, and I started buying some coal stocks. I bought CEIX and I bought BTU at that point in time. Unfortunately, I sold CEIX at the complete wrong time. It's a lesson. It was an emotional sale because the first 10 minutes of their Q3 earnings call in 2021 was all about ESG. And I was just like,
yeah, that's a red flag.
I can't do this.
Yeah.
Coal company, ESG, sell, and now they're 72. Is a horrible sell. It was my worst decision in the last 2 years, but I was on the right track, a mind frame as to where to allocate my money. So there's that, but this is also another graph. The world hit 8 billion people now, right? And of those 8 billion, if you look back like over the last couple decades, more and more have access to electricity where they didn't before. And is that going to continue? Yes, probably the 800 million people that don't have electricity, most of them are in Africa, somewhere in Southeast Asia, they're going to get access, right? And what is going to power that electricity? Is it going to be solar and wind? I would say no. Is it going to be LNG? Let's hope so, but probably not. It's probably going to be coal to start.
It's the most inexpensive, easily accessible, broad-based fuel that these particular societies have access to. They might graduate to LNG and maybe even nuclear down the track, but countries like India and certain African countries, all they can afford literally is coal, right?
Correct. And we can talk about uranium. I mean, uranium is the clear-cut winner in all of this. It's my highest conviction long-term, but short-term, coal's going to print until the world wakes up and realizes that wind and solar isn't going to suffice, unfortunately, or short of, I don't know, nuclear fusion being scaled
overnight,
properly
miraculously.
Somehow. Yeah, exactly. Right. So what you were talking about was this particular slide, right? Every wind turbine depends on steel, and steel basically depends on diesel and coal. And the more that you build, the more coal you end up using. And I have this theory, we're talking about macro right now. So I have this theory, I can't say that I was the originator of it, but I think that a lot of the inflation from 2014 to 2021 was masked by the shale revolution, right? If they had all those companies incinerating money over and over and over with excessive growth to the point where all of their gas was being flared, and the gas that they were selling was selling at like a dollar, You
had the cheapest energy inputs basically of all time, right?
Correct. And meanwhile, China ramped their coal pretty massively, and they were able to produce their wind and solar at ridiculously cheap levels based on their coal prices, right? So everybody's saying that wind and solar are just so much more economic than the rest. I mean, are they? When coal prices are high, when LNG prices are high, when diesel prices are high, what's your price of your wind turbine and solar?
Not to mention the prices of the base metals that go into it, and whether you can even get the amount of base metals that you need to be able to roll that out at an industrial scale. Yeah, absolutely.
Yeah. So all commodities across the board have had underinvestment. I think I got a slide about this. Before we get to this, I saw this, it really bothered me, but that particular chart where you saw 82% of the world's energy usage is like the enemy. Okay, what are the solutions being proposed to reduce that, right? Reduce food waste. Maybe we can do that a little bit, but how much are we going to actually be able to achieve? Lower population growth, kind of draconian. We don't want to go in Thanos territory, get too conspiracy theory on this podcast, but that's pretty nuts. That's like
stop making so much love, you guys. Stop making so much love.
Plant-rich diet. You can't really control people's preferences across 8 billion people, right? Refrigerant management, that's one way, sure. Wind turbines, we just talked about wind turbines. So the overall theme is, short of a mass depopulation event, coal's going to stick around unless we go big uranium or big natural gas, right?
Which is
or
another
both.
argument to say that
which they should.
Investment in energy is pro-human. All this other shit that you just mentioned is literally anti-human. They want less humans on the planet. That's their solution.
Correct.
Crazy.
So crazy, exactly, crazy. But this one's really interesting, right? Everybody just acts like this is normal now. That central bank assets are just going to continue, and one day they'll find Jesus and reduce them and pursue quantitative tightening. I think it's just so false. The fiat debt system requires ever expanding debt. You cannot default on the debt. You must inflate it away. There's only two real choices in the end. And you can have periods where you try to be fiscally responsible and try to raise interest rates, but we've gotten to the point now that we're basically at perpetual negative real interest rates, not nominal interest rates. I put this in there because I think the ECB is probably in the worst shape because of their energy situation. But this is a bit of a delayed chart. It just says that the last time inflation was this high, it took 8 years to bring under control. Inflation's higher than what the graph is now. It's arguably going to take longer. So the bond market has 3% inflation priced in next year. Like, I'll take the other side of that bet personally. I don't know about you. I don't think the rest of the world will follow Jerome Powell's path, right? And especially Canada. And that's part of the reason why I like Canadian energy stocks so much, because they export to the US, and I don't think they can follow the Fed. Now, here's, this was by Charlie Bello. This is the real rates. It's from a couple months ago. There's been some hikes since then, but there's also been interest or inflation increases since then, right? If you look at basically every developed country across the board has negative real rates, right? Yeah. China, Saudi Arabia, Mexico, where I am, and Brazil, one of my other favorites, are the only ones with real rates. They're the only ones with a real cost of money. Everybody else is incentivized to borrow and speculate on assets, because the real assets increase in value while your debt basically decreases against your asset. And that is, in my personal opinion, essentially theft. It's essentially
theft of savers in the system.
Yeah, and it's taking from the middle class and the poor and basically giving to the rich, who are able to take advantage of this particular style of system. So this brings us to commodities, real assets, right? Some people like real estate, sure, fine. I think it's more flat than anything, but as we've already had giant runs in real estate, and it's specifically in Australia and Canada, we're seeing the rollover effects. In some other places in the world, you're going to see more, but commodities are at the point where they're at the opposite end of real estate, right? So if you look at when I made all that money from 2008 to 2011, okay, financial crisis happened 2008. There was a bit of dip in capex, but capex was still ridiculously high on commodities. Like versus GDP, it was ridiculously high. Now it's barely ticked up from like all-time lows, right? And we're not just talking about oil. We're not just, gas, there's been a little bit more investment. We're not just talking about coal. We're talking about commodities across the board. So there's this like turning happening, and what's going to happen over the next decade? Do you want to be buying the dip in tech, or do you want to be buying rips in energy and commodities? I mean, I try not to buy rips, but you still are better off doing that in a rising interest rate QT type environment, which I don't think is going to last. But this just goes to show you exactly where we're at in the cycle. Now, margin expansion, right? Short tech, should we be short tech? Yeah, we probably should have been short tech. I don't know if we should be now, but we probably should have done that based on this particular chart. This is from Warren Pies, who was like my first guy that I followed on Twitter. Twitter's amazing. Anybody who's watching on YouTube, you should follow Warren Pies. This is where your expansion was in the S&P 500. If you look at that energy, it's barely ticked up, right? Yeah. The percentage of energy in the S&P has increased. However, the margin expansion has barely increased. Yeah, it's going to at some point, and when it does, we're all going to make money regardless of which horse you bet on.
And still with without that much happening in terms of margin expansion, the earnings responsibility, if you want to call it, the sector generating earnings is largely energy, and it still only makes up, I believe, less than 5% of the S&P at the moment. I haven't recently checked on the rebound, but
Right.
it's crazy.
I forget what its peak was in the 70s, but it was something like 30%. I don't know. It was like at least 25, right?
And if we go back to the 70s with that chart that you showed earlier, well, it took them 8 years to get inflation under control, but this was starting from 30% debt to GDP. Like, things were way better back then. Now, like, you can forget about that. We're 130% debt to GDP in the US.
And that capex cycle, sorry to cut you off there, but the
No, no.
capex cycle there, they had a lot of capex
Yeah.
during that period of time.
Yeah.
There's
Which
a big
means there was
difference
more
from
supply
now.
coming online.
Yeah. So I don't know how you pull off a soft landing without inflating this away. Like, I think it's all talk. I don't get it. If it happens, I was wrong, and maybe I lose a little bit of money. But I think on the odds are in my favor. Just a couple more I wanted to show here.
Let's do
So
it.
federal funds effective rate versus federal debt, right? This just shows, as you increase federal funds, the interest portion of the debt just increases and increases and increases. Something like I don't know exactly what the number was. It's between 250 and 300 billion every 1%. But at the same time, the increases of interest rates trickle through the economy at a lag. So like in 6 months or a year, that's when you start to see people get real financial stress. And that's when your tax receipts are going to go down quite a bit, right? So
And
not
then
only
how
do you
does the
have
government
the
service the
increased
debt?
expense on interest, but your tax receipts are down. You have to monetize the debt. And this is why Yellen is now basically on the opposite side of the table of Jerome Powell. They're fighting. She wants to be able to buy her own bonds. She wants to cut out the Fed from the equation. I don't know what's going to happen in terms of rewriting of laws. Like, something's going to happen. And I think it's going to end up being Jerome Powell saying, okay, maybe we should have a 4% inflation rate for a few years.
Yeah.
I think that's where we're going. But the rest of the world still can't follow that, right? If the US still maintains their high interest rates, it's very difficult for Japan, for Europe, Australia, Canada. Canada's, I think, the next slide. Oh, no, not quite. But they can't really follow them, right?
And why not? Tell us why. It's one thing for the US. They can set the tone. They can raise rates to a certain point until they hit their own debt serviceability issues, which you mentioned. And where do you think that, would that be a 5% Fed funds rate? A lot of talk that they can get to 5% as a terminal rate. And then after that, because of that mathematics that you just mentioned, it's going to be too hard to service the debt higher than that. But then if you're in Australia, like we've seen our property market, everything's jacked up to the gills. And the RBA has tried to follow the Fed as much as they can, but even though the Fed continued to
Except
rise,
for the last one.
Yeah, at 75 bips, and then the RBA said, "Yeah, nah, we're going to do more 25."
Right. Now, in Canada, the Liberal government has surrounded the entire economy with based on the real estate market. I don't know exactly how much of it is in Australia, but
it's very similar.
Let's just talk about Canada specifically, right? Because
they're very similar.
It'll bring us back to the Canadian oil stocks and why I like them so much. Part of it has to do with the fact that I just don't think the Bank of Canada can follow the Fed. And they blinked last meeting, just like Australia blinked, just like England blinked, just like everybody else, right? So Jerome Powell is reaching the point where, okay, everybody's telling them that's enough is enough. But essentially what will happen in 6 months to a year is a large portion of the Canadian economy, which is one of the most over-levered, I think I have a chart on it, one of the most over-levered, yeah, here we go. House price to rent ratio. Look at Canada compared to everybody else, right? Your cap rates in Canada are horrific. Now raise interest rates. Even worse. People think that, oh, we can just raise the rent on people. No, people can't pay it, right? You get taxed to oblivion in Canada on everything, and they're increasing taxes. The printing was massive. Everybody's way over levered, and you didn't make crazy amounts of money over the last 2 decades unless you were over levered. Everybody who was made a killing. Everybody who, put their effort into their own fruits of their own labor, lucky to be middle class.
Yeah.
Right.
So what are the typical rental yields there for Canada? Because I know how bad Australia is. We were talking offline before how I've just sold.
Negative.
Yeah, negative. That is insane. That is a money losing proposition, and people still made money of it only because of the declining in cost of capital. That's purely it. Same in Australia. Like people thought, we were all geniuses because we went out, like as a 24-year-old kid, levered up to the gills and buying as many properties as I could. It was just declining cost of capital. And then COVID stimulus, and then learning a little bit more. I'm like, I'm out of this and into commodities because this is not going to end well.
Good choice. And then you can compound that if you're like if you want to go work in the mines too, because I know some of those guys can basically get paid whatever they want now, so short of labor. But why is that? Let's just talk about specifically where I am in Mexico, right? Mexico has had real interest rates for the longest time. People are not over levered here. This is a real economy. The price of the unit is at least 50% paid in cash minimum. Most of it's about 100% paid. Like, it's a real market. It's not a credit-based economy.
That's so interesting.
It's very, very different. And a lot of Latin American countries are that way, where they don't have.
Yeah,
Sorry,
if you look at the three currencies that have done well against the US dollar that have actually increased: Russian ruble, Brazilian real, and the Mexican peso.
Mexican peso got smoked at the beginning of COVID, though.
Initially,
so since then they've done well. But they got smoked at the beginning of COVID. What I would say about this is we have, I don't know, if you do a good deal, 10 to 12% cap rates after costs here. That's amazing on real estate. Unreal on real estate. You don't find that anywhere on real estate. That's what Mexico is. I told you my parents have relocated to Mexico as well. They got rid of their place in Canada.
So let's talk Mexican real estate. That's popping up in my newsfeed at the moment. Are we talking you can do what, 50% LVR? You can finance these to a degree. How does that work? Are the mortgages fixed for 30 years? I should
stop sharing my screen for that. We'll go back to oil in just a second. But
yeah.
How do I stop sharing my screen here?
If you just, so we'll stop other screen sharing.
Sorry, I'm a rookie with this Zoom.
Okay. Go. You should just be able
to stop video, right?
Stop sharing screen. There we go. We're back.
There we go. All right.
We're back.
Good. All right. So Mexican real estate. Repeat the question, please? So
talk to us about how you get involved in Mexican real estate, just as an interest, because I know you and also another guest on the channel, Ladislas Maurice, the Wandering Investor, have done a lot in real estate. Can you get mortgages on these properties? If so, what sort of loan to value ratio are we talking? Are they fixed rates? Are they over 20 years, 30 years? As a general layout of the landscape, what is it? Some people get a little bit mad at me when I say this, but I had a line of credit from my Panama bank for mine, and it was against my investment assets. So it's not really against the real estate here. You can get, basically if you're within, I think it's 50 kilometers from the coast, you get a bank trust. Mine's with Scotiabank. So it's a 50-year bank trust that's renewable at any point in time. It's about $500 a year. It's a very small amount. Our taxes, our property taxes are 0.01% per year. It doesn't make any sense compared to the rest of the world, right? Like, you realize how much you're getting taken elsewhere compared to this. You can build a beautiful, beautiful villa for $500,000, $600,000. The return on investment in rental is real, even in the bad properties. You'll get a real return, even if it's a small return, you will get a real return. So from a bank, you can get a mortgage in a bank trust or a corporation. Most people do it in corporation if they're doing the mortgage, but the rates are real here. I mean, I don't know exactly what they are. I haven't seen it in the last year, but I'm assuming it's something like 10%. Okay, but denominated in pesos.
In pesos, yeah, pesos. Yeah. So what I tell other people to do is take the equity out on your Canadian real estate or whatever if you want to buy here and buy here and earn your income and come down here, use it when you want to. That's what the majority of my friends who have real estate have done. They just took a loan out against their equity in Canada and used Canadian dollars. I was really lucky. Like when I found mine, I was having a beer on the rooftop with my neighbor, and he's like, "What do you do? What do you do?" And I was like, "Well, I'm kind of semi-retired. I haven't had a job in a long time." And he's like, "Well, I sell real estate." And I had traveled the world. I'd lived in Russia. I'd lived in Barcelona. I'd lived in Miami. I'd lived in Melbourne. I had never found a place where I thought, "Wow, the real estate here is really worth the money," you know. And he showed me this development, and I was just like, Jesus, how much is that penthouse, the one that I'm in right now? And he told me, and it was I shouldn't say it right now, but it was a very low price. And I was like, okay, I'll take it. Give me a minute. I called up my banker in Panama. I was like, okay, I want to buy this piece of real estate. I just want to know if you guys will give me a mortgage or a line of credit or something. And he took like 10 seconds, looked at my asset. He's like, yeah, we'll give you $300,000. It was prime plus 1.25. I was like,
God bless Panama.
Yeah, I'll take it. I'll take it. Right. So, and I was able to pay that off in like less than 8 years.
Wow. So
yeah, it was awesome. Now I own 3 here, and I plan on owning more in Colombia soon, assuming that, I was thinking about Venezuela. I was thinking about it, it's probably the cheapest place in the world to buy. If we're going to buy low,
talk about high risk, high reward.
We're going to have an oil boom. Maybe the beach in Venezuela is the right place. I don't know, but it's a little bit too ballsy for me.
Well, I have a guest next week on the podcast, and we are going to be discussing that very topic. So it's very interesting. Great minds think alike.
Real estate in Venezuela?
Real estate in Venezuela. Yep.
Wow. Okay. I'll definitely listen into that, because good friend of mine, he's living in the Bahamas right now. He was telling me, James, forget about Colombia, go to Venezuela. Like Venezuela's going to be
a lot of talk about opening up, particularly, and as you mentioned, due to the oil situation, where we just need as much oil as we can get our hands on. Venezuela's got the most potential. We just need to solve some of the political problems, shall we say. Now, we've talked commodities, we've talked energy in particular. You like oil, you like coal. What about this particular niche interest of yours, which is the diamond market? Like, to me, in Melbourne, I remember diamonds were like the Jewish thing. You had the Orthodox Jews, they controlled it all. It was all very kind of hidden, very difficult, opaque market to understand. How the hell do you get into buying a diamond mine?
Well, I'm not a diamond mine owner yet, but the dream is to become a diamond mine owner, right? The dream
and
is.
Why? What's the attraction for diamonds?
I guess most of my wins have been finding resources that were kind of elephants, these big resource plays on discovery. And I feel like we're like inches away from potentially making a big diamond discovery, which hasn't happened in a very long time. Mm-hmm. And I could talk about this for an hour. I'll try to be quick on it. But in general, the diamond market, if you think that the oil market was horrible from 2014 to 2020, 21, the diamond market was that on steroids worse. It was horrific, right? With the introduction of lab-grown diamonds, plus massive overinvestment in diamond mining in general. So many companies were on the verge of bankruptcy or went bankrupt or shut in mines. If you look at the chart of like diamond production, I think it's down about 30% from its highs.
Okay.
Alrosa dominates the market in Russia, which is another interesting thing. Like, they can get their diamonds to market, but most of them are these melee tiny diamonds. The opportunity, in my personal opinion, are in colored diamonds and large diamonds. And large diamonds really only exist in a couple places in the world. And we might have found the next diamond mine. Well, I shouldn't say we have found it. I think we're very close to finding the next diamond mine that could produce large stones. There's only a couple of them in the world. They exist in Africa.
So it's exploratory stage. To someone like me that doesn't understand anything about diamonds, Are we talking like for jewelry? We talking industrial purposes, drill bits,
They're
and that
like
sort of thing?
these are like scepters for crown prince type diamonds.
Okay.
We're not talking about things like,
So decoration for one of your
okay,
penthouses, let's say.
yeah, yeah. I plan to line a bathtub with diamonds. No.
I
Okay,
can see it.
before I get into the story, I'll just say this. The guy who found the first diamond mine in Canada, he's the guy who did the geochemistry lab results on our drill core. His name is Chuck Fipke. He spent 8 years in the Northwest Territories looking for the Acadie mine before he found it. And when he found it, it became a multi-billion-dollar project. He's worth hundreds of millions of dollars, and he's assessed thousands of kimberlites from around the world, right? Not many of them have become mines, but he has a database of it all. And when he saw our geochemistry, he called up the CEO. When I say our, I'm a shareholder. I'm not like part of the company. Just let's be clear about this. But he called Glenn, the CEO, in the middle of the night and said, what you have, I've rarely seen before. It's similar to the Letsang diamond mine in Lesotho. And that's where like large diamonds come from. They produce some of the largest diamonds in the world, but it's also very, very low grade. In general, when you're looking for a diamond mine, when you look at the drill core, you want to have a lot of micro diamonds in it, right? The diamond population gives a bit of an indication as to how many larger diamonds will be there and what type of diamonds there are, whether they're contaminated with nitrogen, which gives them a yellowy color, or whether they aren't. But the geochemistry of the Letsang mine shows that a lot of the non-diamondiferous material came from something like 400 to 600 kilometers beneath the earth.
Right.
Do you know what a kimberlite is?
No idea.
Okay, so kimberlite's arguably the rarest rock on earth. They're these ancient volcanoes that bring the diamonds from the lergolite and diamond zone deep within the surface, or deep under the surface to surface. And how could I describe this? Okay, put it this way. When carbon dioxide builds up in the crust, like if you shake a Coke bottle up enough, the top will pop off eventually, and all the Coke will come with it. That's essentially what happens with the magma in these ancient kimberlite explosions. Okay. Carbon dioxide builds up in this specific area of the earth and finds the path of least resistance through the rocks in a very, very explosive manner, explodes on surface, right? And collapses back in on itself. Sometimes there are multiple eruptions over, millions of years. Sometimes there's multiple eruptions in like one pass, but it's like a volcano that erupts once, essentially, right? Okay. And the diamonds come to surface, and then in Canada specifically, glaciers erode the surface over time. You're talking about 2 to 3 kilometers of ice above the Earth's surface. Nothing exists underneath it over millions and millions of years. So this brings us to what we're looking for right now. What we found is something very, very unique. The prospector that RJK did a deal with was in the field like Chuck Fipke was for 8 years. This guy, Tony, his name's Tony. Tony Bishop, he spent 5 years looking for these diamond indicator minerals, which are like millimeters in size. And he found an incredible number of them in sizes that only exist near where the pipes are, because these glaciers, as they move across the surface, pulverize everything underneath, right? Gotcha. It becomes less than dust, less than millimeters in size, right? You can't even look at it under a microscope. The further it goes, most of them. So what he found was amazing. Now, what's really interesting about this whole thing is, when I say we're on a real life treasure hunt here, and what we found is trying to mark an X on the treasure hunt map, essentially, there was a hen's diamond, hen's egg sized diamond, found about 115 years ago in the area. It was called the Nipissing diamond. Okay. And we know the size of it because there was a picture of it in the mining journal in 1906. This particular, and there was multiple other publications, right? And the settler who found it didn't know it was a diamond. Diamonds don't, when they're rough, they don't look like they are when they're cut, right? Okay. It just looks like a nice, cool rock. He sold it to the local MP at the time. His name was Adolph Oban, who got it authenticated and sent to Tiffany & Co. in New York. Tiffany & Co. in New York cut the diamonds, sold most of it. The Oban family kept some pieces, and then sent a team west of Lake Temiskaming, where we were searching, to look for more diamonds. That's kind of where the story kind of goes cold. Now, in the 1960s, De Beers, who held the monopoly on the diamond market for a century, arguably the most successful company enterprise in the history of commodities, they started searching at that point in time to the north of where we are, about 20 kilometers north. And then in the 90s, there was a big rush when Dr. Keith Barron, who found the Aurelian gold mine in Ecuador, after that, he was searching for the source of the Nipissing diamond. Back then, he found some kimberlites to the north. Unfortunately, wasn't economic. Our lead geologist, his name's Peter Hubachek, he found the 92-5 pipe, which was the closest to being economic, but it was under about 50 meters of overburden. So the pipe itself was very buried. And in order to mine something like that,
where it was.
Yeah. In order to mine something like that and take a really big sample, you would have to invest a lot of money, and their results were good, but they weren't great. So the area is diamondiferous. What we found is different geochemistry to everywhere else, all the other historical kimberlites. And we found massive tonnage basically on surface. I got to share a screen to show you this.
Yeah,
first.
let's do it. So you have access now. Let's take a look at this diamond. I feel like
I don't know how to do this again. How do I do this? Participants, chat.
Yeah, so if you go,
I'm on full screen right now. You?
Screen. So you have share screen back on.
Okay. This thing keeps popping up at the top of my screen. I need my tabs here. Okay, so that's the sketch of the diamond right there, and somebody put a nickel next to it. That was from 1906.
Okay, that's a fair rock we're looking at.
Yeah, it was big at the time. In the publications, of which we found 4 of them, there were 5 of them actually. It referred to it as one of the largest diamonds ever found at that particular point in time. And all the rest of them were basically found in Africa. This is like the only one. So this is just south of Cobalt, Ontario. This is the land that RJK has staked, and since then they've been quiet for the last little while, staking. But what they found here, I'm going to move you.
So they've got leases and rights on discovery in those areas you've marked out.
Correct. Yeah. I'm trying to find interactive. Okay, so faults and dikes. The faults, where we have all these videos here. This is an interactive map that we made. Well, Inside Exploration made. They're fantastic. The blues are the major deep fault systems, and then the orange lines are the cross fault systems. All of what we found are along the major fault systems. So what we thought was the kimberlite. I don't know if you can see my hands. Can you see me on screen? Yeah. Okay. So we thought the kimberlite went up along the fault systems, right, and it erupted underneath the last glacial event. Now that would be very rare to have such a young kimberlite, but how else would it get in between the bedrock and the overburden, right? Everywhere else, the glaciers stripped off everything off the top, and when they melted, they left the overburden, and there's bedrock below, and there's a clear cut in between them. There's no mixing, right? As the glacier moved along. Yeah, what we found, let's see if I can find this here. Parity Pond aerials. Yeah, interactive map, total claims area. Yeah, I'm gonna have to put it on another screen here. Oh, good. What we found is this here. Okay, every pink area is an electromagnetic conductance anomaly. This particular one is about 2 kilometers by 500 meters on surface area, right? Okay. And that's filled with diamond indicator minerals, and some of which come from very deep in the ground, just like or when you say surface area, how far down can this EMG
kind of measure?
Yeah, it's an EM signature, so electromagnetic. Some areas, like up here, you can't see this one, but Chown Lake comes to surface. Nicole Lake is within 2 meters of surface.
Okay.
Parody Pond averages about 4 to 5 meters. Down in the gravel pit area, it's, I think it was 5 meters. This is the deepest one. It was about under 11, between 11 and 20 meters. But all of these, what we thought we were drilling kimberlite, direct kimberlite, right? That essentially spread out underneath the last glacial event. What we found out recently from, we hired SRK Diamond Consultants. They're some of the best in the world. They've done work on all of the African mines that produce large diamonds. They think that this was redeposit, the kimberlitic type deposit that we have that contains microdiamonds. Like the first drill core we had 18 microdiamonds in a 22 kilogram sample. Very, very, very good result.
Okay.
What
would a typical grade be for something like a diamond mine?
It varies so much because what we're looking at, like if our closest comparison is the Letsang mine in Lesotho, their grade is incredibly low, but the amount of 10 karat plus diamonds that they produce is the most in the world, right? Okay. So they'll invest $2,000 in taking out rock and take out, you know, hundreds of tons and get 3,000 back, right? So and they've been a mine for 50 years. They've had horrible years and unbelievably profitable years. It's very different, but they're in the middle of nowhere in up a mountain range that costs an immense amount of money to put into production, whereas these are all on surface, right? Wow. So we have the correct geochemistry for large diamonds. We have micro diamonds within it, but they're not native kimberlite deposits. They're not the all of the rock coming from the same place and breaking through. They came up somewhere else and were redeposited in this area, likely in an under glacial river system.
Okay.
But there's really only two options. Either it was located from somewhere very close by, because we have what's called macrocrysts of forsterites, which are like large, forsterites exist in large diamonds found in Africa. They grow in the same area as these large diamonds under the earth, right? So we know we have the right geochemistry. But if it was from very, very far away, these forsterites would have been pulverized into nothing.
Okay.
The source of it is somewhere localized. Okay. The challenge is determining where it all came from. Now we have massive tonnage, but it's not all kimberlite. A lot of it is, you know, everything else that came along with it underneath the glacier. So there's really two options. Either it's somewhere close by, and RJK has been waiting for a while to get their drill permits on a couple different targets close by, or it's a little bit further away and it's enormous. Like when I talk about looking for elephants, in order to deposit this amount of material in
from
this
a site further away,
right? If you look at the scale here, this is 3 kilometers right here, okay. Right? We're looking at a, you know, more than 10 by 10 kilometer area here, and there's more. So wherever this stuff came from is either an enormous kimberlite that's like the mother of all kimberlites, potentially, and likely contains large diamonds based on the geochemistry, or it's localized and could be potentially a couple of these different types. So that's where the company is at right now. It's really exciting for me because it's been about 3 years that I've been in on this project, and when we found out the geochemistry information from Chuck Phippie, the stock went, you know, to 30 cents. When we got the results from the rest of the drilling that said, okay, there's not a lot of diamonds in this, the stock went back down. And then over time, we eventually got this SRK report that says, okay, it's not native kimberlites, it's almost like redeposited kimberlite sources.
Which suggests it has come from a bigger base and moved into those areas, right?
Potentially. I can't say for sure. I can't say for sure, right? Yeah. Now, there's a number of targets, right? A lot of these things, like there's one other thing here. I'm just going to say this before we move on.
Yeah.
The original Wolf of Wall Street's name was Bernard Baruch. If you look him up, Bernard Baruch is one of the most famous investors in the world. He's like the Warren Buffett of the early 1900s. Okay. We think that potentially the Tiffany expedition that came from New York to search for diamonds in this particular area might have been Bernard Baruch's two brothers and his best friend who financed it, because in this particular area right here, they staked land claims in February of 1907. We went through thousands of historical records to find out where New Yorkers searched in the area. Like, where did the New Yorkers stake their claims during that period of time? After the report came that Tiffany & Co. was sending a team to look. It's interesting, right? Because they were ridiculously wealthy. And to the north, there was the most profitable silver mines in the world at the time in cobalt. Like, to give you an example, you could mine in the Discovery vein, you could mine a ton of the rock for something like, I don't know, in today's dollars, like 30 or let's say 40 or 50 bucks, and sell it for about 30,000, right? It was pure silver, what they found.
Wow.
And these guys came in the winter from their cushy places in New York to this particular area and didn't buy any of the silver mines, as far as we can tell. They staked claims 9 kilometers south, less than a kilometer away from where we found our first diamonds, and on one of the other geophysical signatures that we just did a land deal on earlier this year. We haven't sampled it yet. We're going to. But we think that this might have been where the Nipissing diamond was found, because there was a wagon road built during that period of time. You got to think, like, put yourself in 1903.
Yeah, in 1903.
Right? How are you going to find a diamond? Is it just going to be sitting on top of a rock? No, probably underground somewhere. It's probably not right on surface.
So were they originally looking
Building
for
a road
silver
makes sense.
in that area?
What's that?
Were they originally looking for silver?
Yeah, cobalt's brilliant, man. You should see some of the videos of it. The town burned down twice, but a lot of mining engineering in Canada came from cobalt. Okay. And all of the, like, you know how you have here in Mexico, you have the pyramid ruins. Mm-hmm. There you have mining ruins.
Yeah, wow.
It's really, really interesting. So 9 kilometers to the north of this area is where cobalt is. And these same like the Cross Lake Fault here and the Montreal River Fault here goes up into cobalt as well. So the town's more or less a ghost town now. There's been no silver mining there since I think the 80s was the last time. It's kind of upsetting, considering my family's kind of from this area. Like, the management of this company, they're all graduates from the Haileybury School of Mines, and they all had their own teacher who told them the story of the Nipissing diamond. And that particular teacher's name was Jungle Dan. And this guy said, I really hope one day one of the graduates of the Haileybury School of Mines finds the source of the Nipissing diamond. So 5 of them have gotten together to try to solve this mystery, and they're pretty damn close. Now, I'll just leave it with this. We think they got their drilling permits just, I think it was today or yesterday, for a couple of different areas. But when I first visited the property to see what I was potentially investing in this treasure hunt, De Beers was flying helicopters over my head with VTEM, what do you call it? It's geophysical. It's like a giant contraption hanging from a helicopter. I don't know exactly how to describe the area
out anyway.
Yeah. They were doing it at a giant scale. I don't know how much money they invested. It must have been $10 million doing this, because they did it not only where we are, but over an incredible scale over the area. And I just thought to myself, like, geez, De Beers they saw the same prospecting reports as we saw. They tried to do a deal with Tony Bishop. Tony Bishop saw the offer from Glenn and RJK and decided to go with the small company where he'd get more leverage. And I'll never forget that, seeing the helicopter fly over my head, just thinking, like, Jesus Christ, De Beers is searching here. Like, there's got to be something here. And they started searching in the area in the 1960s. They've kind of been obsessed with this story just as much as we have. So I don't know, man. I hope next time we talk, I'm a diamond mine owner. I hope that I can dig up a egg-sized diamond myself with my own bare hands. I hope that these particular deposits that we're looking at here host large diamonds. The only thing is, after this SRK report came back, we might have found the source of the Nipissing diamond in one of these, but it doesn't really make sense for us to take a large bulk sample versus trying to drill for where it came from. Because large bulk sample will be millions and millions of dollars, and we want to keep the leverage on the company. Like the management owns a lot of shares too. We want to find where it came from.
So with that in mind, how long will it take to get something like this potentially, let's say you find something into production? What will the capex look like, and how will you fund that production?
I don't think it would be funded. I mean, I don't think it would be funded by any of us. It depends, right? I mean, you would do a deal with a diamond mining company. Okay. Diamond mining companies are pretty much focused in Africa. They were focused in Australia before, but not anymore. I think you probably know the Argyle mine was closed there. In Ontario, De Beers closed their Victor mine. To give you an idea of how profitable the Victor mine was when they found it, it's in the middle of nowhere. They invested about $1 billion to build it. They paid back the $1 billion in year one.
Wow.
And they had 11 years of profit afterwards. It was nuts. It was mine of the year in, I think, 2009 or 2010, something like that. But when they found that particular mine, they didn't know it was a mine. They put it on the back burner. They kept the rights to it, but the geochemistry wasn't right based on their models, based on their African mines. But when they went back and took a look at it, they realized, oh, wow, we have these eclogitic garnets in here that we should have good quality diamonds. And then they took bigger samples, and sure enough, they found significant diamonds. But really interesting about that deposit, there weren't micro diamonds in it. There weren't very many micro diamonds in it. Just like in ours, there's not very much micro diamonds. However, the quality of the diamonds that we potentially could find, if on a big sample, if we find the source of this geochemistry, is likely such that, you know, could be a company maker, certainly a mine maker. It could make me a Hefe, you know. So I don't know, and it's a potential elephant. It's a potential, I don't know, blue whale type thing. Your leverage is immense, but it's the most high risk of high risk possible things, right? So anybody who is interested in this, like, it's a risk investment. It's a lottery ticket. I call it the best lottery ticket you could find. And it's so cool. Like, how many real life treasure hunts do you get to participate in? Like, how many? Not very many in life.
That's true. And it's certainly an interesting speculation. Now it's ROI time, mate. I've got to ask you, what is you've had quite a few. What is, maybe just pick one, your highest or your favorite ROI from any investment today? You have done very well in precious metals, but I'd be interested to hear what sticks out in terms of when you look back at the investments you've made, the best ROI. Maybe give us a little bit of a backstory and run the numbers as best you can remember.
It's probably great. Well, most recently, Great Bear Resources in Red Lake, Ontario. I bought the stock on their first drill results. They had incredible drill results. I forget exactly what it was on that first drill. They called it the hinge zone, but then they looked at all of the geophysics of it, and it could have been enormous, and it was even bigger in the end than they thought. I bought it at about $1.40 first purchase. I bought some more in the twos. Then it went back down to 1.9, and the company was taken out less than 2 years later at $29.
Oh.
So that was my most recent big win. And not only that, but they had a royalty kicker. So midway through, management was like, okay, we want some more of this for ourselves. And they did essentially kind of like a rights offering where you could buy a royalty in advance of any particular production. And that also ended up getting bought out. It was a separate like spin out stock that was the royalty of their potential future mine. And that added an extra, I don't know, $5 a share or something like that to the investment. So I think my average was about 240, and it probably paid out 34, something like that. So that was my most recent big win.
It's a nice day's work.
Yeah. I've had a lot of 10 baggers, and I've had a lot of doubles. And I've somehow managed to stay in the resource sector and not get my face ripped off. So I don't know if I'm incredibly lucky or doing something right.
Okay.
One of the two.
Sounds like you're doing something right to me. I would love to catch up with you a couple of months down the track and talk exclusively about this ability of getting in the exploratory phase, how you pick your exploration stocks, and hopefully we get an update in terms of RJK Explorations. Before we wrap it up, is there anything I missed? Is there anything that you wanted to go back and talk about or share with us before we wrap it up?
I mean, I could talk about all these subjects constantly. So I mean, if we do this again, we can continue with it. But yeah, just to sum it up, I mean, the coal trade looks great. Oil stocks, I mean, just this week, Biden said we're stopping the SPR, which was like a huge thing, right? Everybody thought that, oh, we're going to get another 100 million barrels coming through. That's not coming.
12 million inventory draw on crude oil, and potentially China reopening. A lot of noise being made around that. It's
actually 14 with the SPR, right? So something like that.
True,
so,
if you adjust.
Yeah. I mean, when the SPR stops, then you start seeing what real commercial levels will be. And it's pretty nuts. And he wants to keep the SPR for the next election cycle, the next 6 months before November 2024. So I feel like we got a pretty clear sailing over the next year. Other than that, no, I mean,
And are you playing that mainly by Canadian producers, or you're interested in the offshore?
Entirely.
Like we see, so there's no offshore for you where you look at that low capex. You're not thinking, okay, eventually when that capex starts to come up, that's likely going to be the income for the offshore or oil field services plays. You're just playing the straight producers.
I mean, I've owned the offshore services and bought and sold them, but they weren't core holdings. Like Val, I made a killing on. I admittedly bought rig when all the pumping started on Twitter, and I made a quick 30% on that. I bought one of the other ones just for like a week, and also I've made money on them all, but I haven't held them all. So I can't say that it's a core holding. Outside of Canada, Petrobras, which I think you're involved in as well. It's one of my favorites. Like, when do you ever get to invest in a super major that trades like a junior? They're treating it as if Lula's already stolen everything. It's just, to me, you talked about NAV. You talked about difference of NAV to the equity value. Well, Petrobras is like a no-brainer on that particular measurement. So there's that. Yeah, I love the high calorific coal. I just love that so much. I feel like Australia is going to make a lot of us a lot of money. So we can leave it at that. We covered diamonds, gold, energy.
We covered a lot.
Real estate,
lifestyle. I enjoyed it very much. Well, thank you so much. I really appreciate that, my friend. Guys, follow James on Twitter. Links will be in the description, and I look forward to catching up with you for another chat down the track. I think it'll be very, very interesting to see what the developments are like. Take care, everyone. I look forward to catching up with you in another episode of the ROI podcast. Until then, take care. Goodbye, everybody.